presentation of Financial Crisis Recovery.
Foreclosure, short sales, bankruptcy, credit card debt, job loss, depreciating home values, money management. Peace of mind when it comes to your finances seems completely out of reach under current conditions, but there is a way to achieve it. For the next 60 minutes, you're going to find out how to cover your assets. Cover your assets. Now, here's nationally renowned speaker and expert on getting you on the path to financial strength, Todd Rooker.
Good morning. Welcome to Cover Your Assets. We are here again Saturday morning talking to you about everything related to financial crisis. If you're in one, how to deal with it. If you want to ensure that you never are, insulate yourself, lock yourself down, as I like to say, with an estate planning and asset protection plan to ensure that everything you've worked so hard to build is insulated and survives a financial crisis. That's what we're going to be talking about. And frankly, everything financial. My job is basically to know what the CPA, the attorney, the financial advisor, the mortgage broker, the credit specialist, and the real estate agent all know rolled into one, and to create a cohesive strategy that addresses all of those things, as opposed to piecemeal, where you might go to each individual professional and wind up walking away after each meeting more confused than when you started. My job is to bring it all together. With that said, I work with what I would consider to be the very best professionals that exist. I've spent over 20 years seeking out the people who are extraordinary at what they do. And that way, when I meet with a person and do a consultation and I send them in the direction of a CPA should they need one, or an attorney, a bankruptcy attorney, a real estate attorney, an estate planning attorney, I send them to the very best so that they don't have to waste their time smiling and dialing in the telephone book, only to find out after 3 or 6 months and paying a horrendous retainer that they're working with the wrong person who may be actually learning on their dime and isn't really an expert in that particular area. So I like to surround myself with those professionals. The topic of today's show is taxes and tax planning. Our guest this morning is going to be Arliss Richardson. She's a little bit late getting into the studio just because she's had a little trouble with her GPS finding ESPN that apparently doesn't even their address show up on the GPS, but we should have her in here shortly. I'd like to start today's show by sharing some invaluable information. To succeed financially, you must begin to develop a financial vocabulary. This is something I talk about a lot. So listen carefully today to the topics and the terms being used and what they mean. This will enable you to have a more meaningful dialogue with a financial professional, and most importantly for today, with your accountant, that professional. I get clients all the time who are looking for help and need help going through what might be a financial crisis, doing their best to make changes, but they've never really learned the financial basics. And if they had, they could be in a much stronger position and may have never gotten into the problem in the first place. So, with that said, my guest today is Arliss Richardson, who's just walked into the studio. Arliss, good morning. How are you?
Good morning, Todd. I'm absolutely wonderful.
Well, perfect timing, I'm telling you.
I try to be that perfect person.
Well, I was scared to death that you were I was going to be doing taxes and tax planning on my own. God forbid. I sure don't want to do that. So, Arliss, why don't you introduce yourself and the services that you provide to your clients?
Okay. Well, my name is Arliss Richardson, and I established a CPA firm back in 1990. I've been doing taxes since I was 14. I absolutely love what I do, and I try to strive myself to be the best CPA for my clients to help them solve their problems and just reach their goals.
So when you say you established Arliss Richardson Ltd., which is a CPA firm and an accounting firm, when you say that, there's quite a contrast between that and I started doing taxes when I was 14, because I know you're about my age, and we don't need to get into the specifics, but we're talking about a long time you've been doing this work. Is that an accurate portrayal of things, Arliss?
That is absolutely an accurate portrayal. I absolutely love what I do. I think I came out of the womb knowing exactly what I wanted to be.
Isn't that fabulous? All right. Well, so listen, as always, I want to open the phone lines up for callers right away this morning. If you have questions about taxes or tax-related issues, please give us a call. That number, 651-646-8255. If you have tax questions or concerns, please give us a call, and we will field your questions related to this. And you're going to be talking to Arliss Richardson, who is an extraordinary CPA and works with business owners, self-employed, and obviously anything in between as well. So, Arliss, I speak to a lot of people today, my clients and people who come to my classes, and they're receiving 1099As and 1099Cs from their mortgage companies, and they'll come to me and want to know, what is a 1099A? What is the difference between that and a 1099A and C? And just have a whole lot of questions. So could you briefly say, what does it really mean? What is it when you get a 1099A, and what things do you need to be concerned with?
Okay, well, for starters, the first thing that you're going to receive is a 1099A. And what that is that means that the bank or the investment company has taken your property over through a foreclosure. That 1099A is what starts the tax ramifications, if there are going to be any, on the sale or the liquidation of that piece of property. A 1099C is after the bank has sold the property and now they are recognizing the amount of debt that they have forgiven based on the value of that property and what the original note was for that property. If the 1099A or the property is foreclosed on and sold all within the same year, then you will get one 1099C in lieu of getting an A and a C, but the same results will be from the 1099C as if it were an A and a C.
So really, number one, the 1099A actually represents, if I'm not mistaken, abandonment. Is that correct? Is that what the A actually means, or does it have another connotation?
It has another. There's a difference between a property that's been abandoned versus a property that's been foreclosed on. So the 1099A does not represent abandonment. It just represents that the bank has taken the property.
And so then when it's a 1099C, that is debt cancellation. Is that correct?
That is correct.
And so what we're talking about, when you get the 1099A, it's because they haven't really realized the difference between what they'll actually sell the real property for against the outstanding loan, and then they'll calculate that, and that will become the 1099C, which is if my mortgage is $200,000, the property sells for $100,000, they'll take that $100,000 against it, which will leave an outstanding balance of another $100,000, and then you get the 1099C for the 100. Is that what that means?
That is exactly what that means.
Perfect. See, I got to know a little bit about
You
that.
have. You've educated yourself quite well.
All right. Well, very good. All right. So, if a person does get a 1099, regardless of its A or C, and they do end up with additional taxable income, could that additional taxable income as a result of the 1099C or what have you, which really means that they're sending that to you saying, look, this is loss on our side of the table. So as a result of us canceling this debt off, we're going to send this to you as though it were income. So when that happens, and if you do have to pay tax, could that affect your ordinary income tax, let's say from your job where you make $50,000, $60,000, $100,000 a year? Could that affect the income tax that you pay on your personal income for your income that you earn in a job, or won't they affect one another?
Absolutely. What's going to happen, that 1099C is going to come to you on your tax return in addition to any other income that you've got. And that 1099C income is going to be calculated and taxed at ordinary income rates.
Wow.
So depending on what your income is, if you're in the 10, 15, 20, 28%, 35% tax bracket, that's going to come to you at whatever tax bracket you're in, and you're going to pay tax on that dollar amount.
Is there any difference between, let's say, when I negotiate on a credit card debt, say I owe $100,000 in credit card debt, I'm able to negotiate with the credit card companies for $50,000, and I get, combined with all these credit card companies that I've now negotiated with, a $50,000 debt cancellation. Is that ever considered passive income in that it's a lower 10, 15% tax bracket, or will always be considered ordinary income tax?
It will always be considered ordinary income tax. It will never qualify for anything other than that.
There it is. All right. Well, that is fantastic information. So, if you're listening to this and if you're dealing with real estate, if you're dealing with negotiating credit card debt, one of the things that you really need to be aware of is that when you settle debt, you will always have potential tax. Not always. And we're going to talk about the times when you don't. But you always have to at least have a consideration of the tax that one might have as per the difference between between an amount that you owe and a settlement, because from the bank's perspective, if they're losing money, they're going to write it off on their side, as I like to call of the table, by sending you a 1099. Just because you receive a 1099 doesn't mean you're actually going to have to pay tax, but you may very well receive it, and a lot of people by that alone are assuming, my goodness, I got 1099 for $100,000, now I owe $100,000 in tax. Well, that's surely not the issue, is it?
No, that is not the issue. It triggers taxable income, but it does not have a 100% tax bracket that would be on it.
Well, that alone is going to make people feel a whole lot better. So if I'm looking at how to calculate a tax, which is a pretty complicated thing, one of the things that I try to talk with people about, and I know this is going to be a little complicated, but when you purchase a piece of property, let's say an investment property, you buy it. What you buy it for is not unlike buying an investment. It creates a basis valuation. If I buy a piece of property for $200,000, if I have $100,000 worth of loss because I short sale a property for $100,000, if my mortgage was also $200,000 and I financed it right up to 100% when you could do that in those days,
yep,
I've now lost personally my basis being $200,000, a sale price and a short sale of $100,000, but I'm also going to get a $100,000 deficiency or 1099 from the bank. How might I use my personal loss, the difference between the sale and the basis purchase price, as compared with the $100,000 1099 that I receive? How would that work? What is that calculation, Arliss?
Well, it's very interesting because you've got two types of investment properties. If your investment property is been put into service as a trade or business, such as a rental property, then that loss that you have triggered from the sale of that property through the foreclosure would be treated as a trade and an ordinary loss to be able to take against other income. So the debt forgiveness income would come to you as ordinary income for $100,000, and then you'd have a loss of $100,000 from the sale of that piece of property, and at the end of the day, you'd have a zero tax consequence.
Because your personal loss would be equal to or greater than the income that you got, and you could offset the two by doing that.
That is correct. But now where it gets a little tricky is, let's say that same piece of property is a cabin that you own up north that you use as a second home and as a vacation property. The rules there become a personal loss, which you and I both know when you've got a loss on a principal property or on an investment property that's for personal use, it is non